Dhiraj Agarwal is with us, Managing Director, Ambit Investment Managers. Dhiraj, great to have you with us here on the program. Thanks very much. Are you on in the camp which believes that, and mostly people are, especially on the sell side, that things are looking a lot more constructive as we look into 2026, and there's money to be made here?
I think things are looking constructive, yes. I am a little bit of the same camp at this point of time. Although I will add a little bit of caution there. I'm cautiously constructive. I don't see a huge up move. It will still be a stock picker's market. At the index level, we will see the markets grind up rather than explode up. So that's where I may differ a little bit from the rest of the market. But yeah, that's where I am.
Now, Dhiraj, I must actually compliment you because that caution was ahead of the curve. It was sort of well taken because you've been maintaining a cautious stance on the market for several months, for the better part of this year, if I remember correctly, talking about, concerns like earnings, and valuation. So, yeah, kudos, that call has played out. But now that you are turning, from totally cautious to cautiously optimistic, tell us what's shifting. And let's start with the earnings trajectory itself. Having heard a lot of the corporate commentary at the end of Q2, I mean, at the macro level, look at those GDP numbers. They look fantastic, right? But we need to get sustained double-digit earnings growth. Do you see that happening this year onwards?
So let me start with the controversial topic, which is the GDP number, right? I mean, the real GDP growth reported this quarter, or September quarter, is 8.3%. But the nominal GDP growth for September quarter is actually slightly lower than the June quarter at about 8.5, right? The corporate earnings and corporate sales growth actually track nominal more than real. And there is a little bit of a hot debate going on at this point of time that some portion of our GDP under the new methodology is calculated as nominal and deflated by the deflator to arrive at the real. So maybe the low deflator is artificially inflating the real number at this point. So let's just focus on the corporate earnings growth. For September quarter, Nifty earnings growth is just 6 or 7%. BSE 500, X of OMCs is only 7% to 8% range, which is all very weak. So the reason for being cautiously constructive is the two big triggers that we have seen recently. One is the large GST cut. Second is the continuous decline in interest rates. Both these put together hopefully result in sustained consumption revival in the second half, and hopefully results in better earnings trajectory in the second half. The jury is still out. Some of our channel checks are indicating that in few pockets, demand has already started weakening post-Diwali, which is not a very good sign. But there are reasons to be cautiously optimistic.
All right. Hi, Dhiraj. Good morning and good to see you. Ben, let's leave eternal to the side. Let's focus on the next one that I want to focus on, right? Let's look at it with a lens. I recall when the Lenskart IPO came out, you were a little bit more positively biased on it. And to be fair, the stock sold off 10% on listing day. And after that, there's been a lot of interest. We know there's a big market out there. Valuation debate continues, but otherwise the business appears to be shaping up well. What's your view on the name from here on? It's held up actually, though we have a fair bit of the float that's limited, at least as of now. Your view on this name?
So honestly, I don't have a very concrete view on Lenskart at this point, but if I take the discussion a level higher in the current environment, markets have become valuation sensitive as compared to valuation agnostic for even high growth companies a little while ago. And you started this discussion by quoting internal. You can see that pressure on internal stock price also in the last 1 or 2 months. And it's across the board. Many of the high growth companies where valuations were extraordinarily high are not able to move up anymore. And the primary reason for that is, when I spoke about earnings slowdown. So while there is earnings slowdown, there is no earnings crisis. This is a very important distinction to be made. Last time we saw earnings slowdown between 18 to 20, there was an earnings crisis as well. And hence, the few pockets where earnings growth was strong, valuations kept on rising. This time, the same thing will not happen. And that's why we need to be cautious on valuations too.
Yeah. Dhiraj, allow me a minute on this. And I just want to tell viewers as well. I think, this was 7th November. Ambit did come out with a sell call, and the 12-month price target on Lenskart now that Ambit has is 337, which is probably one of the most bearish targets on Lenskart. Remember, on the other end of the extreme, you have someone like Jefferies. Jefferies is calling for 500 on Lenskart. So, Dhiraj, this is not a stock call discussion at all, but I think this also highlights the kind of market we are in, which is why as investors, it's really important to understand what's going on. Lenskart reported numbers are fine. There's margin expansion, around 19% margin. EBITDA has gone up. Revenue's also gone up, a fair bit. But the market clearly, between, your very cautious view now, Ambit's cautious view, and someone else who's calling 500, is very, very polarized. Yeah. So how should investors navigate a situation like this, where technically earnings are fine, there's nothing wrong, there's no corporate governance issue in the company, but you just don't know how to understand the valuation debate? And Lenskart is not the only one, right? We have a whole pipeline of new listings that's coming up ahead, from NSE to Meesho to whatnot. So this is important for viewers and investors to understand. Just help us through this.
Yeah, so we tend to be a little bit more purists when it comes to valuations. Sometimes it works, sometimes it doesn't. So let's say during the 18 to 20 period, when a number of consumer companies were just continuously going up despite valuations, our analyst calls, at least on the stock price, appeared to be going wrong, because we took a purist view on valuations, and many of the stocks we had sell calls on. In the current environment, looks like the market has become a little bit more valuation sensitive, and exactly for the reason which I described, that you are able to find reasonably growing companies at much better valuations today in the market, and hence investors are not willing to pay exorbitant valuations for a similar growth or slightly higher growth.
So the Lenskart downgrade was a pure valuation call.
It is. It's a pure valuation call. And in fact, that's what makes the market. At all points of time, you need a buyer and a seller in the market and simultaneously. Otherwise, stocks would just go up circuits or down circuits all the time, right?
No, absolutely take that point. Okay, so let's talk about what you are liking. I mean, you've liked financials in the past, but give us some more color. With the index at all-time highs, where should we train our lens, buying lens, that is, in terms of new ideas?
So it's a continuation of the thought which I just expressed. Across sectors, it's possible at this point of time to identify companies where the growth rates and the fundamental metrics look either similar or better, and then you focus on valuations, which is relatively cheaper. So we are back in that kind of an investing time zone. So you mentioned BFSI. Take BFSI as an example. So all large banks at this point of time, the credit growth is similar, 10-11%. Earnings growth is similar, 10-11%. ROEs are similar, around 16%. And hence, one is better off choosing a stock which is relatively cheaper. And which is exactly why names like SBI, Canara, some of the second-line banks like Federal, CUBK, have been performing significantly better than the frontliners like ICICI, Kotak, and HDFC, because it's similar growth or better growth with slightly better valuations, right? So we're seeing that happen in IT. LTI with a better growth than TCS, Infosys, etc. has done better, and so on and so forth. So it's one has to slice and dice growth, some of the other fundamental metrics, obviously like ROC, free cash flow generation, and then compare the valuations. You can't just buy the best and the largest, unlike in 18 to 20 cycle, and hope to outperform.
Okay, all right, got that. Dhiraj, we'll leave it on that note for this morning. Thank you so much for joining in. Good to get the perspective on the market with you today. That's a view from Ambit coming in, and they're turning cautiously constructive on the market for this time.